Hey everybody, Preston Bryn here for our weekly roundup. This is for the trading week ending December the 11th, 2015. What an interesting week we had. I've got the weekly chart up here, but first, let me just come over to the daily. I want to show you guys a couple of things. Um, this past week, the S&P opened the week around 2092, and it closed the week officially around 2001. So the week we were down about 4.3%. Now, for the year, for the high for the S&P for the year, the high point was 2134, and we've given up about 6.4% off the highs for the year for the S&P, of which over almost 80% of that was just this past week alone. From the highs, I mean, or at least for this week. So you can see here that the week was not a very good week for most of the markets. Now, there are a couple of things that I'm going to be paying attention to. You can see we've got a very important pivot low here on this daily chart. If I blow it up a little bit so that you guys can get a better view of it, you can see this move here. And we came down, we hit it, we moved up above it. Just slightly, but that key pivot low there, we went a little bit below it, but you could see we closed just north of that at 2001 and a quarter. So the key question is this going to hold? Or are we going to have one of these head fakes where we open up and then we immediately sell off? Excuse me. And we take out that low and we continue lower. The charts would seem to indicate to me at this time that this is probably the higher probability move at this point. Now, keep in mind, next week is triple witching, and it gets its name because we have monthly expiration, normal monthly option expiration cycle. We have the quarterlies expiring, we have the futures expiring, future indexes. A lot of them, if you're using Thinkorswim, they automatically moved over to the March E-mini futures contract. And also this Tuesday we got volatility futures expiring, the December volatility futures expiring, and then we run out to January. So we're getting a lot of volatility all across the board. So let's take a look at each of these charts and just kind of see, you know, what we could possibly expect as we move through the end of the year. And keep in mind, I pointed out numerous times that the market has a traditional bullish bias as we go through the end of the year. Primarily the last 2 weeks, 3 weeks of the year, it tends to be more bullish. In fact, the last official 30 trading days of the year tends to have been bullish, at least for the past decade, every year, 1 to 2%, where it opens and where it closes 30 days before the end of the year to the end of the year. Remember, our October was very strong in the S&P. We moved up about a little over 8%, 8.5%. So I don't think we're going to give all of October's gains up as we go into the end of the year, but we got a lot of dark clouds on the horizon here. So looking at just pure price action here, you can see this is going to be a very key point for us. We've got coming up this week the all-important Federal Reserve potential interest rate hike. The Fed funds futures market is pricing in about an 80% chance of a 25 basis point rate hike. That's 20.25%. So this is probably, should that occur, this is one of the most telegraphed moves the market has been expected. Now, of course, the markets have been expecting a rate hike from Janet Yellen-led FOMC almost for the entire, for almost every quarterly meeting they've had this year. Quarterly meeting is when Janet Yellen officially does her press conference. So that's generally when it was forecasted that she would do a rate hike. So most people have been expecting a rate hike at the end of Q1, Q2, Q3 of this year. And like Lucy in the proverbial Peanuts cartoon, and Charlie Brown, she always moves the ball away, and Charlie Brown ends up trying to kick dead air, and he falls on his ass. However, this time I think I don't think I've seen the Fed funds futures probability much higher than this in quite some time, going back before they started raising rates. over a decade ago. We haven't had an interest rate raise for over a decade. Now, we've been lowering rates until we got to the 0 to 25 basis point hike, but this is kind of where we're sitting right now. Um, so the markets have already been forecasting that. So we could see the bond market and the currency market, primarily the US dollar, do just the opposite of what many people think, meaning the dollar gets a little bit weaker. In fact, it started getting weaker a few weeks ago, and bonds getting a little bit stronger. And it can be confusing to a lot of people, but really it makes a lot of sense if you sit back and think about it. And we'll look at the bond chart here in just 1 minute. So getting back to the E-minis on this daily chart, you can see here that we're sitting, and there is a really tough zone right here, or a solid support zone. That purple line is a 50% fib node, sitting right around 1986. Okay, and that's a fib node from this high here, going down to a pivot low that we made before we started that October run. You can't see it off the chart, but that's kind of where it went, like that. So this is a pretty good solid area here. Should this break, then this whole it throws in doubt a number of different things. And let me just step out a little bit and I'll show you what I mean here. Should it break, we can sit here, and we could come down and test this low down here around 1850. We've got another key fib node around 1956 in this area here, which I think will provide some resistance and just kind of our final stopgap measure here before we start to move back up. But if that breaks, we're going down very ugly. You can see the RSI here is well below 50. It's at 3672. So again, everything has been bearish. Now, it's not an ideal bearish divergence, but as I've been talking to our members, we need to be careful here. An ideal bearish divergence, we would have made a higher high here, but this is very close, and you can see the weakness in the RSI as we came up and just about hit the 2110 area, and then it just started rolling over and it gave it up. And you can see on this daily chart, we also blew below the 50 EMA, which is the red line, and then the 200 EMA, which is the yellow line. So now we're sitting at this area right here. It's going to be really interesting to see how the markets open Sunday night, the futures market. The momentum may carry us a little bit lower. And in fact, some people consider this kind of a blow-off bottom this past Friday, and then with triple witching, the markets tend to grind higher. And the fact that it's in the fourth quarter, that adds even more energy or wind behind the sails on a grind higher move or a bounce back. But I'd be very cautious here. And we could get one of these kind of moves just like that up to about a 50% level of the entire day's move, right? And then a roll back over again, and then we take out that low and we test this low right here. That would be what I would anticipate. But with the Feds coming out on Wednesday, remember the Feds can just take any chart and any price action and turn it upside down. You just do not know. But if we get the anticipated move here, then I would expect 1986 to hold, and maybe we blow off a little bit below it. But then I would expect this run from 1986 down to 1956. I would expect it to hold. Keep in mind, the big nut that all big international money funds, sovereign wealth funds are trying to figure out now is this. China's in a slowdown, Japan's in a slowdown, Europe's in a slowdown, Great Britain's in a slowdown. Most of the emerging markets have been in a slowdown for quite some time. The only market that's been expanding a little bit is the U.S. markets, and then Great Britain right behind it. And then Germany is part of the 19 countries that make up the ECB. So the big question is, will the rest of the markets start to catch wind with all the stimulus and move higher? and the U.S. maintains its slow and steady expansion, very slow, painfully slow. But will that happen, or will the markets in the U.S. give it up because of the slowness globally, and then the markets in the U.S. roll over? And when that happens, then the global markets will have a more severe move. So I've been saying for the past year and a half, and I know my members will certainly support me on this because I say it 2 or 3 times a week. The Feds are between a rock and the hard place. Um, if they had started raising rates in 2013, 2014, then the guess for this year or for this meeting would be not so much are they going to raise rates. No one would expect a rate hike, but would they reduce rates? So now they're in this enviable position where they may have to rate hikes just to get off the bottom. That's what the markets are expecting. If they don't raise the rates, you're going to see a large sell-off, I believe, because understand it's more psychological than anything else. A 25 basis point rate hike does nothing for most of the valuation models out there in the big money. It really does nothing. Where everybody's concerned right now is with the oil prices. Oil is kind of unraveling right now, and it's causing a contagion in other markets, primarily in the debt markets like junk debt and high yield corporate bond debt. And it's also causing problems from the standpoint of earnings overall in various sectors, as well as keeping inflation lower than it should be, if not stagflation, in most markets. Oil, we're going to take a look at oil in just 1 second. But that's what's happening right now, and that's where the markets are trying to determine what's going to happen when the Feds raise these rates for the first time in over a decade. For our members Sunday night and then Tuesday for our pre-market session on Tuesday, I'll show you some really interesting ways to make an unknown trade like that in the options market. We've done it 3 times before in the euro market, in the oil market, and in the bond market, and we've been successful with that trade. So we're going to be looking at that again Sunday night and then Tuesday morning. But anyway, this is what we're looking at on a daily chart with the E-minis. Now, if I clean this up a little bit, and let's go out to a weekly chart just to show you, put some perspective on this. This weekly chart, I've got the fibs on here as well. And you can see going out in time, you can see the lows that we made on March 9th, 2009. And I've run some fibs. And you can see here that I like to use the 0.236 retracement level. It's not an official fib level. The first official fib level is 0.38 and then 0.5. But you can see in very strong, excuse me, secular bull markets, 0.236 is a common pullback point. We almost got to it back here on August 24th on that intraday hard down move. But the fact that looking at this weekly chart, we're just not, you can see the RSI slowly rolling down like that. I mean, it's very clear visually to the eye. And that means that basically we got a lot of weakness here, and there's a lot of fear in the market that this move down could be a precursor of further down movement in January, February. And I had a seminar a weekend or so ago, and I had said that I personally felt we could grind a little bit higher towards the end of the year, but then come January, February, we're going to have a nice little sell-off. Now that could be accelerated to starting now. History would seem to indicate that that won't happen until January, February, but as you guys know, history is really bunk to follow where the current price action is. The momentum clearly is we're very choppy at this point in time, but you can see this next level down, which is the first fib level in a strong secular market, would put us right around 1789, okay? And that would give us a nice pullback from the markets and what we've seen from the highs of that 2134, okay? And if you look at that, the 2134 that gives us a 20%. That would put us in official bear market territory as we start off the year. And that would end this big move that we started in March 2009, running up here like that. Now, we and this is not a very solid trend line, but you can see we broke it, and now we kind of back up on it again. We're trying to come back up above that trend line, but I believe we're going to have a little bit of momentum up. Wouldn't surprise me to see some momentum towards the end of the year and then a roll back over again. So we got to look at our portfolios and just kind of expect that kind of move. Now, if we don't get it, good for us. We just continue to plow higher. I think the end of 2016, the markets can be higher than where they are here, but I do believe we're going to have a little bit of a indigestion here coming up. Now, the other thing that I wanted to talk about here is if we look at the other markets. By the way, the Dow is 6.4% off the high, same as the E-mini, 6.4% off the highs. Nasdaq's only 4.5% off the highs. But where we're really having trouble here, look at the Russell. Now, I've got a lot of drawings on this chart here. Let me try and clean it up just a little bit. You can see here on the Russell, this line right here was the low for the year in the rut, all right, for 2015. And it's at 1071.40. And then the highs for the year for the rut were right here at 1292.30. And you can see here that we had a really good signal to go long right in this area here as we started moving up, because we had really bullish divergence in this move. But we gave up a key level right there. All right, you can see that key level, and it is a key support level. So in the small cap, it does not look good, right? I mean, we're certainly looking like this thing can probably come up and retest that level, and then maybe roll back over. And the small cap gives it up, and we come down and test the lows for 2015. Then I can assure you the other markets, the odds go up over 65–70% that the other markets can give it up too. Remember, small cap is a risk on, risk off barometer. So the small cap for the year is off 13.7% from the highs made right there for the entire year. All right. Now, if we also, let's look at the mid cap and just kind of see how the mid cap is doing as well. And we're going to see from that standpoint also that the mid cap is not doing that much better. Now let's look at it via MDY, which is the gauge of the mid cap. You can see here with the mid cap that again we're off the highs from the year of about 10.3%. And as this market continues to roll, we've got a pretty good little support area for the mid cap, much like we do for the Russell, right down in this area here. So if we can hold this level, it will be a good thing. But this does go to show that money is coming out of the small cap and out of the mid cap. And when we see that happen, risk is clearly coming out of the market. Okay, so risk is just flowing deeply out of the marketplace. You can see this blue line right here, 1203.90. That's the opening price of the Russell futures for the year. And you can see we're well below 1203.90 for the year. So again, we are in the red. If we look at the E-minis, oh, by the way, let me just put the Russell back up real quick. I want to show you. Look at the 50 is below the 200. Both the 200 and the 50 have a downward vector on it. All right, RSI below 50. We're coming down to oversold conditions, but again, the momentum looks like it's still down with some counter trend rally. So we're in a sell the rally mode right now for sure. If we look at the E-minis, and let me just put all my indicators on it, it's going to get very busy here. But again, you can see here this price action right here. We're in a wide support zone here, hence this great area here. But you can see the 50 is over the 200, but they both, the 200 is flat, the 50's got a downward vector, and we're testing this key support area here. So again, and this blue line is the opening price of the S&P 500. Now remember, I said the S&P 500 futures for the week fell 4.3%. So we're back in the red here for these guys also. And if we look at the Dow, same thing for the Dow. You can see this blue line right here, 17,781. That's the opening price for the year. We're well below it. We've got a little bit of a, just like the S&P, we've got a key level that we're sitting on right now. So we've got a key major inflection point that we've got coming into this week. I guess it's appropriate, which is why volatility is so high right now. And then if we look at the best index, which is the NASDAQ futures, you can see the opening price of the NASDAQ 100 futures, 42.40 for the year, this blue dash line. We're well north of that. And we've got good separation between the 50 and the 200 EMA here. So, you know, that's the only bright spot in the markets right now is the NASDAQ. And some of the larger guys, you know, Facebook, Amazon, LinkedIn, Google, some of the larger guys are kind of holding this up a little bit, but we've got to be very careful here. For our members tomorrow night, we'll look at the breadth of the market and see what's underneath and how it's shaping up. Now, another thing I want to show you guys is an all-world index. This does not include the United States and the U.S. markets. You can see here, and let's just, this is a daily chart. But you can see here, it peaked in May, June timeframe, and then it just started giving it up. So you can see the rest of the globe. You remember my opening statement? I said, let's look at the contagion for the global markets, and will it bring the U.S. markets down? You can see this every time the global index, VEU, Victor, Echo, Uniform, and it's a Vanguard ETF, but it's a good tracker for just the global markets, not necessarily China or India or Japan or Germany, Europe, Great Britain, but just globally. And I like to look at it from time to time. But you can see it is clearly not doing very well. The other one that's not doing very well is the emerging markets. And I was suggesting to our members that we put on some shorts in the emerging markets. You can see here, if I were to put this trend line on like this, you can see here just kind of how it's moving down. Now remember, if the dollar gets stronger, the emerging markets are going to get weaker because a lot of the debt they're holding is in U.S. dollars. So this is why Janet Yellen is in a conundrum right now. Of course, if we look at and again, this is just most of the emerging market. But if we look at China and look at the Chinese index, you can see here we were on a nice steady up move, but we broke it back right after Thanksgiving here in the U.S., right around November 22nd or 27th. And now you can see we're coming back down a little bit. So it is showing more signs of weakness. So that's what's got the markets concerned right now, big time. And if we look at volatility, the VIX, well, it closed up 26%. You can see the gauge right here. We took out the prior high back in November, and now we're coming close to trying to challenge another key area here when we had some moves down in August. So remember, the volatility does not stay high very long, but these spikes, you got to be in it to win it if you want to hedge your market with volatility, or hedge your portfolio with volatility, which means you should already have some way out of the money calls in the volatility index. Now, the other thing that I had talked about is oil, and oil is really got a lot of things going on. It closed at 35.36. Look at the oil market here. We made new lows. If we look at, let me just get my oscillator up here. You can see that on these new lows, we got a little bit of a bullish divergence going on. So that does seem to indicate we can get some strength here. But my system is indicating to me that we can go lower. In fact, what I was calling for with our members was somewhere down in this area here, right around $31 a barrel, $32 a barrel, and the timing of that was really towards the end of December to the mid to late January timeframe. Okay, that's what I was calling. And you know, you can see over here when we got short oil at this area right here, I was calling for a low right here. I missed the timing just a little bit, but we hit it perfectly. And then we got that bounce and a steady move, and now we're just moving back down, and now we're coming to my next targeted time frame. And so we got both time and direction keyed in here. And that's where it's looking like it's going to go. And should it hit that, then I believe we're going to have some great trades in 2016. This is a great short trade for us in the oil market. Gasoline, same thing. Gas is a little bit more volatile. You can see these spike ups. We've been playing very short term these moves right here. These are counter trend moves. You can see, if I were to put it like that in a uh, uh, channel, maybe I could draw the channel just a little bit better for you guys. It looks something like that, right? So it's clearly a down move, and I'm calling for an even lower move, a sub $1 move. If we get oil in the low 30s to high 20s, we're going to see this here, and that would be the condition that would move the equity markets down another 4 to 7%, and then we would hit some of those numbers I told you below or before in January, February timeframe. We also got some huge bullish divergence coming in here. And you can see these counter trend moves are very quick, primarily because there's a lot of shorts in this market right now. And these counter trend moves, or the velocity is very fast in these moves because of the number of buy stops in here on these short trades. But once we start to consolidate, I envision something like that where we have this move like that. So we're kind of in this process right now in this consolidation phase. It's very choppy, but this is going to be a great trade for us. Just like these shorts were were a good trade earlier in the year for us. Excuse me. Now, the one other thing I'm going to look at here, because I'm going a little bit longer than normal for this free weekly update, but I want to look at the treasuries in the bond market. And I had said this earlier too. Bonds finished up over 2 handles. Now, you remember, and just to show you how really crazy the bond market is. We had this huge, we haven't seen this since February of this past year. That big candle right there, I mean, it was just huge. And if you look at that candle, we started right here and we came all the way down to there. Huge move. That was over a 4.4 handle move right there. And then no sooner did we do that than the bonds, bam, came right back up there over the next 2 or 3 days. Huge move. And people are going, well, why are bonds going up and interest rates going down when the Feds are going to raise their rates? It just does not make sense. Interest rates should go up. Well, what's happening, if you look over in Europe right now in their debt, especially the German Bund, they are less than 50 basis points. Over here in the U.S., for us, we are greater than 2.2% to 3% in this area right here. So big money is looking at this and saying, wow, I've got a lot of money here in German debt and other European country debt, but I'm only making about 50 basis points, maybe a little bit less. I'm going to take that money and move it over here and invest it in U.S. debt. So what's happening is it's having the contra effect that you would think. The bonds are moving up, interest rates are moving down. Now, when we get the Fed hike, possibly, more than likely this Wednesday, then you're going to see we may have a little bit of a down move. But again, as long as we have this big delta between the European debt and the U.S. debt, the money is going to want to tend to flow from the right to the left, meaning from Europe to the U.S., keeping our rates artificially lower than they should. When Europe starts to catch wind, inflation starts to come back, and their interest rates start going up, there is going to be a huge sucking sound in the U.S., and the U.S. Bonds are going to fall through the floor. And you're going to see the money come back to Europe. And by the way, it's not only Europe, but it's also Japan as well. All right. So there's a lot of money sovereign money moving from Japan and Europe into the US, and that's what's causing this crazy effect. This is what happens when you get a lot of central bank meddling, and we got it happening in Europe, Japan, Australia, India, a lot of emerging markets. We got it. It ended in the U.S. We're going the other way. We're going to try and take some money off our balance sheet. It's in Great Britain, the ECB, all over the place. So that's what we have going on right now, guys. So a rather long update, but I wanted to show you we've got a lot of things going on. If you're not a member of our group, I highly encourage you to come in and join. These markets, just you've got to be very careful, but there's some profit opportunities out there. But more important, I think 2016 is going to be a very interesting year, and there's going to be some great plays that we want to make. Position trades, and we're already starting to establish some positions now. So check us out. I've got an offer attached with this free update for the weekend. If you're not a member, come on in. If you're a member, I will see you this Sunday night, 8 p.m. Eastern Standard Time, and we'll go through a weekly market watch for what we can expect next week with the Feds and some ways to play some of these unpredictable moves. Have a great weekend, everybody. I'll talk to you